Thank you for having us today. We are Silent Assassins. I am Sharonda Moore.
I am Bernice Campbell.
I am Brianna Styles.
And I am Shanice Burnett.
And we're coming to you as your auditors because we audited you, Starbucks, and we wanted to shed light on some of the findings that we had within your financial statements that we believe you should be aware of going forward within your operations. And so, based upon our findings, we'll start about just a little bit about your company. Starbucks being a multi-billion-dollar company, started in Seattle, Washington, and it has expanded into the U.S. as well as into global markets such as Africa, the Middle East, as well as Europe and China. And so from there, we wanted to also inform you that you've been known to be the premier coffee retailer serving teas, different pastries, as well as coffee, which is your main product. But you've been, over the years, expanded and acquired different companies such as Tazo and Tiavana. And so, based upon those findings and just the environment, knowing that you are a morally ethical company and that you pride yourselves on making sure that you're ethical and the employees are as well, we were able to assess and say that as far as the audit risk, we would be able to have it at low. But at the same time, we wanted to make sure that when we were going through our findings, that we assessed it with the mindset of what's the possibility of what can go wrong within your statements.
In addition, as you may all aware of, you had a recent craft arbitration that caused your litigation charge to go up in 2013. However, we noticed with your financial statements that you were able to pay off this charge within a timely manner, which allowed you to be able to decrease it, but still have this on your notes and your disclosures. In addition, we noticed that your companies were heavily relying on the amount of consumer spending and the discretionary earning of your customers, as well as the healthy eating index and how those people pride themselves in eating healthy. However, we see that your product list and your inventory, that you have multiple different products that can help to mitigate the risk of people wanting to eat more healthy. We also see that you have some strategic alliances here with JP Morgan Chase, Google, and Danone. The Google one, what we see is it's just an agreement, and in order to provide quality Wi-Fi to your customers. We see that we want to make sure that you are sure to disclose any of these strategic alliances in your financial statements and any related party transactions, because of these are strategic alliances with these companies. Anyone else have anything to add?
Okay, and so now we're going to move on into inform you about our findings. We'll start with the balance sheet, and we're going to start at the top with assets. And within assets, we'll go directly to cash, being that cash is the second largest account on your financial statements within the asset section after property, plant, and equipment. And so with cash, what we've come to understand is that when you're accounting for cash, you're accounting for all the sales, all the credit card sales as well, because if it's within 2 to 5 business days, you see it as a cash transaction, as well as other financial instruments that have maturity dates within 3 months. And so with cash, being that it is based upon sales, you have a high fluctuation of cash within the fourth quarter due to the holiday sales, with the increase of customers coming to the store, as well as buying the store value cards, where they're putting cash onto the cards for future customers to come in and purchase some of your products. And so with that being said, we want to make sure that with cash you have certain controls in place in order to mitigate the risk of customers possibly of employees not recording the sales and taking the cash for themselves, or being able to misstate some of the sales, so that way your cash account is not misstated in the future. And so with that, we gave cash having a high inherent risk because it's very soft and it's very accessible to many people. And so to mitigate that risk a little bit more, we're asking that you have a lockbox and that you have supervisors, and being able to have a registered login of seeing who was the employee on that register and all the sales, and being able to account that the cash matches up to the sales that they did register within the cash register. And so with that, another control would be just making sure that when we're accounting for the revenues, with it being cash basis and it's not being accrued, that everything that we have recorded is within the cash statement.
Okay, so the next account that we'll talk about is property, plant, and equipment. And with that, we assess the inherent risk at medium because you guys lease some properties and you own some properties, so it'll be really time consuming and expensive to have to go in and check to see how much, to see if they were valued at the correct amount. So whenever you're accounting for property, plant, and equipment, you want to make sure that whoever's in charge is actually recording the depreciation expense and are using the same depreciation methods. So each month, whenever accounting for property, plant, and equipment, you want to have somebody that'll go in and check to make sure, well, somebody who didn't do it the original time, but you want to make sure that they can go in and check to make sure that the depreciation methods were the same and at the correct amount. And you also want to make sure that the expense was actually recorded. And so the next one that we have noted, the next account is deferred income taxes. And with that, we assess you for low because it isn't often that deferred income taxes will be misstated. And if not, you can always go and check with the government to see if the amounts that were recorded on the book were recorded at the proper amount than what they gave you.
So after assets, we will talk about your liabilities. So far with the most significant one we found was accounts payable. And we noticed that you have a lot of price-based contracts in order to gain the needed supplies and products you need in your inventory. Since you guys do these contracts, we found that we assess this risk as pretty low. Although the volume of the transaction is high, we saw that it's pretty standard, and those qualities in the contract will be carried out in a timely manner, so it's easier for the process to be standardized and it's not as complex as most accounts payable accounts would be. We found that it relates to attribute risk. However, we want to make sure that all those accounts and all those transactions and accounts payable are actually included. So the most important audit objective for these will be completeness and accuracy, and to make sure that when evaluating these liabilities, that there is no risk of potential misstatement, mostly due to understatement of these liabilities, because any understatement could severely impact your overall financial statements. However, for the control risk for the entity control that we decided, because it was such a high volume of all journal entries, because it was such a high volume of journal entries going into this accounts payable account, we determined that key personnel should periodically review to avoid any transaction not being recorded. And because the contracts are being used, we will make sure that the price stated in the contract is a price being put in as the transactions are being recorded. The next account for liabilities that we deemed important was your long-term debt. We noticed that mostly your long-term debt was due to the litigation charge, so that would increase significantly in order to pay off the litigation charge that you accrued. And as well as there was some other notes payable involved into this long-term debt account. Because this long-term debt aspect of it is inherently risky because we need to make sure that all notes are being included, but we found a good control in place as long as you're reconciling these accounts with the bank statements to make sure that all notes that were on the banks that you were borrowing this money from are included in your long-term debt. Once the proper notes, and we make sure that these are all included in your financial statements, it's important to review these notes payables to make sure that all payments being made on them are being properly reduced to the accounts, as well as any interest expense are being accrued in the proper period.
Okay, so next we'll move on to equity. The first significant account that we've seen on you guys' books was common stock. Of course, common stock is a low risk account, meaning their prices are based on the market and the economic conditions of the market. We know that it's highly regulated by the government, so it'll be a low susceptibility to fraud. Also, we know that the inherent risk of common stock would be the risk of the company recognizing shares that were repurchased. to recognize the shares that were outstanding that were already repurchased by the company. We do have entity level controls that we can put in place by having the appropriate accounting personnel who has the experience and the qualifications to know how to recognize the shares or how to classify the share, correctly classify the shares. We also have, with the internal controls that we have in place, we know that there's no additional testing needed for the company, because we have supervisor personnel that goes back and review the journal entries and approve basically the journal entry before they're issued out on the financial statements. Another account that we could look at for equity would be retained earnings. Retained earnings is a highly material account, as seeing that it's made up of accounts from the statements of earnings and the statement of stockholders' equity. Basically, if net earnings is already overstated, this will overstate retained earnings as well. Also, if for example, the company fails to recognize dividends that were paid out for the year, this will understate retained earnings. Also, we can have entity controls in place that mitigates the risks of managers not recording the actual amount of dividends that were paid out. We could have basically a revenue recognition criteria in place that is associated with GAAP that could basically note, so companies would know when to record revenue and record revenue in the correct period. So that wouldn't affect the net earnings or the net income. Moving on to revenues, we see that you guys have 3 segments of revenues. You guys have the company operated revenues, the licensed stores, and the consumer packaging, food service, and other revenue segments. Of course, inherently, your revenue accounts are highly risky. But overall, looking at all your revenue segments, we can say that the company operated, being the largest segment, that would be the most riskiest revenue segment for your company. Here we can look and see that the revenues can be complex based on the calculations. The licensed stores and the consumer packaging revenues, those are based on third-party transactions. So I would say that would have a low susceptibility to fraud, seeing that you guys are trading or buying and selling goods with third-party vendors who represent non-fictitious vendors. Also, we have entity-level controls that we can put in place for revenues, such as we could have a monthly operating report that looks at the variations or provide documentation for the variations and the fluctuations that's in revenues. We can also look at have supervisory personnel go over the work of store managers, making sure everything is correct and that there's no unusual fluctuations in revenues. Also, another way how the residual risk that's left over after the entity level controls, we could basically go back to GAAP and have them, as long as you guys are following the GAAP procedures and recording revenue according to GAAP, and also recording revenue in the proper period, then the risk are being mitigated. And we can also move on to expenses. The main problem with expenses as auditors that we look for is if the expenses are understated, because companies will understate expenses to make their companies look more profitable. Here we can see that expenses, it can be misstated because there are a lot of estimates included in expenses based on, for example, depreciation expense and amortization expense. Those deal with a lot of estimates that the company, based on judgment call, see how long do you want to depreciate your asset for. We see that here we could have entity controls that report correctly by having qualified personnel, and also have the monthly monitoring of the expenses, and have a report printed out at the end of, before the end of the fiscal year.
So in terms of control deficiencies, I guess what we most noticed was that because you do your accounts payable, the charges to your accounts payable are based on contracts. It's a little more difficult to keep track of each of those transactions separately. So the control deficiency in place would be to make sure that the control deficiency would be there's no control in place to make sure that those contracts are matching correctly with your transactions at each one. So we suggest that a competent accounting personnel should go back into those contracts and periodically and maybe by quarter checking to see that as products are being gained or as you made payments on them, that the proper accounts payable account is being updated accordingly.
With the findings of the control deficiencies that we did find, there were a few within cash due to the fact that the inherent risk is high. With cash being very accessible to plenty of people, one of the control deficiencies that we saw was that there is no absolute way in order to protect cash, but you have to have certain controls in place of making sure that there's supervision, making sure that the employees are ethical, and making sure that the recordings of cash are not handled by the same people who are counting the cash, but there's a separation of duties within the accounting department handling cash as well as within the retail department on handling the cash. And so with that being said, we found that cash has a high susceptibility to fraud, but as well as high transactions, and the material misstatement for it is high as well. But there is it's a low control for standardization, as well as having no estimates or judgments, being the fact that cash would be recorded as is and doesn't have to be adjusted for any fair values or any adjustments for inflations.
Right, and just all in all, because you guys do most of your sales with cash, it's really important, and this account would be more risky. Also, with your rewards program that you have set up, it's not directly cash, but you guys treat that as cash. So we want to make sure that your systems and the technology in place to monitor that cash that's in place is accurate, up to date, and performing at the best and highest quality.
After reviewing your financial statements as well as your controls, we did not find any significant deficiencies nor any material misstatements. And so we thank you for your time, and we appreciate you contracting us to provide this external audit for you all.
Thank you.
Thank you.